We handle them every single day. They are the invisible pipelines for nearly every financial transaction we make. Yet if someone asked you to define the fundamental mechanics of your bank account and the debit card that unlocks it, I mean, not just what it does, but the technical core, you really do it.
It's a great question because it's the ultimate invisible architecture of modern life, isn't it? We think of money in our accounts as, our property, just sitting there waiting for us. But the actual relationship between you and your bank, the institution holding your funds, is structured by these profound legal concepts most people just never stop to analyze.
And today, that is exactly what we're going to do. We are absolutely going beyond the simple swipe. We're doing a deep dive into the legal, the structural, and the operational definitions of financial accounts, and of course the complex, sometimes really messy global payment systems they connect to. Our sources for this are dense. I mean, they're drawing heavily from global legal frameworks, technical distinctions, and we are going to synthesize it all for you.
That's right. Our mission today is to illuminate that surprisingly complex relationship, the one between your funds, the institution that holds them, and the payment tech you use every day. We want to deliver some crucial aha moments, about risk, about technical structure, and critically, it's all about understanding the deep architecture of modern digital finance.
Okay, so let's unpack this. To really get how a debit card works, we have to start right at the foundation. We have to start with the core identity of the bank account itself. So at the most basic level, our sources define a bank account simply as a formalized financial account. It's maintained by an institution, a bank, a credit union, whatever it may be, that just records that continuous stream of transactions between them and the customer.
It sounds incredibly simple, and that's because the process of opening one is so common now. But the real complexity, it lies in its contractual nature. What's absolutely crucial to grasp here is that the bank unilaterally sets the terms and conditions for every single account type it offers, whether it's a standard checking account, a high-interest savings vehicle, or even a personal loan account.
And when a customer signs on the dotted line, or let's be real, clicks, "I agree," in an app today, they're entering into a legally binding agreement.
Exactly. That click immediately forms a contract between the two parties, and that contract dictates everything. The interest you might earn, the fees they can charge, penalties for unauthorized activity, and most importantly, the respective rights and obligations regarding the funds.
And the practical output of that contract is what we all see on our screens. The comprehensive record of all those transactions, that's your bank statement. And the final balance, that number you check constantly on your phone, is simply a reflection of your contractual financial position with the institution at that exact moment.
That's the perfect high-level view. But here is where we hit our first, and I would argue, our most important legal distinction. This is the key insight that fundamentally changes how you should think about your own wealth.
And this all centers around a concept called bailment.
Precisely. In almost all modern legal systems across the globe, we're talking common law places like the US and UK, civil law systems in Europe, a deposit of funds into a bank is emphatically not a bailment.
Okay, hang on. Let's define that for everyone listening. What would it actually mean if my account were a bailment?
Great question. If it were a bailment, it would mean that when you hand over, say, a $100 bill, the bank is just acting as a temporary caretaker. They'd be holding your specific property for safekeeping. You would retain ownership of that tangible $100 bill, and the bank would have a fiduciary duty to return that specific property to you whenever you asked. Think of it like storing jewelry in a safety deposit box. That's a bailment. The bank is just guarding your stuff.
But bank accounts are fundamentally different.
Critically different. The moment you deposit money, the actual physical funds, they cease to be your property. They immediately become the property of the bank. This concept goes back centuries, actually. It's rooted in the development of promissory notes and fractional reserve banking. It evolved from the days of the goldsmiths who realized the cash they held was fungible. It could be mixed together.
So if the bank legally owns the physical cash I just deposited, what do I own? What's left for me?
You, the depositor. You acquire a claim against the bank for the sum you deposited. You no longer have a claim to the actual cash you handed over. Instead, the bank has become your debtor for that specific amount. The bank now owes you that money.
That is a staggering shift in perspective. It means when I check my account balance, I'm not looking at cash I own. I'm looking at the sum that the bank owes me. It puts me and the bank in a legal relationship that's fundamentally built on debt.
And that debtor-creditor relationship is exactly what allows the bank to function as a lending institution in the first place, because they legally own the funds, they're entitled to use those funds, they can lend them out to other customers, start businesses, whatever. They just know they need to maintain sufficient reserves to meet your demands when you decide to exercise your claim. When you go to an ATM or write a check.
But this feels so counterintuitive and maybe a little scary for the average person. If the bank owns my cash, how is my money legally protected if that bank fails? Where does something like deposit insurance, like the FDIC in the US or the FSCS in the UK, fit into that debt relationship?
That is an excellent point, and it's the legal system's crucial backstop. The protection is entirely based on this debtor status. Deposit insurance doesn't cover your cash because, well, the cash isn't legally yours anymore. It covers your claim against the bank, up to a certain limit, of course, like the $250,000 in the US. If the bank fails, the insurer steps in to satisfy the bank's contractual debt to you. It's insurance for the debt owed, not for the physical property. Understanding that difference, it just clarifies the entire structure of financial safety.
That makes perfect sense. And this whole distinction is then formalized in how these accounts get recorded on the bank's own books, which dictates the accounting rules. Asset versus liability.
Precisely. If we apply that debtor-creditor insight, then for the bank, the money they owe you, your deposit account, is a liability. It's a debt on their books that they must settle upon your request. Conversely, for you, the account holder, that same deposit account is correctly recorded as an asset. It's something of value that you own.
And we can see this concept work perfectly in reverse with credit, which is, I think, a lot easier for people to visualize as a debt.
Absolutely. If the bank issues a loan or a line of credit, the accounting rules just flip. The loan account immediately becomes an asset of the bank. It represents money owed to them, a future stream of payments. And for the borrower, that loan is now, of course, a liability. Our sources really emphasize that banks have to meticulously document whether these loan accounts are unsecured. So, based only on the borrower's promise to pay, or if they're secured with some form of collateral or a guarantee, that detail determines the bank's risk exposure.
Okay, before we move on to the different types of accounts, we should spend a moment on the mandatory mechanics of opening and maintaining one, because that's where these huge global financial laws really intersect with daily life.
Right. And that procedural rigor is absolutely essential for financial stability and security. National laws heavily dictate how bank accounts are opened and operated. This is primarily governed by things like Know Your Customer, or KYC and anti-money laundering, AML regulations. This means they have to specify things like the acceptable forms of ID for signatories and the specific procedures for large deposits and withdrawals.
And what about who is legally allowed to open one? I know global standards are pushing for financial inclusion, but there's still a pretty firm line on minimum age.
There is. The minimum age for legally entering into that contract that you need to open a full bank account is most commonly set at 18 years old globally. It aligns with the age of majority. However, to foster, financial literacy and inclusion, some countries, like many in the EU, permit accounts to be opened as young as 16. But these accounts are typically structured either as limited transaction accounts or they require a parent or guardian to act as a co-signatory or a trustee until the minor turns 18.
And that brings us to the most foundational rule of all, identity.
Yes. One non-negotiable principle, and it's universally enforced worldwide, is that it is unlawful to open an account using a false name or an alias. Our sources underline this as a primary defense against money laundering, terrorist financing, and serious fraud. The identity of the claimant, the person the bank owes the money to, must be verifiable. No exceptions.
So the foundation of your money in a bank isn't cash, but a legal claim. It's governed by a strict contract, secured by deposit insurance, and protected by rigorous national laws on identity. Okay, with that clarity, let's explore the structures these contracts create on the bank's balance sheet.
Okay, so when we transition from that legal foundation to the operational structure, we immediately run into some terminology confusion. It's mainly because the words debit and credit completely flip their meaning depending on whether you take the bank's perspective or the customer.
Right. And we always have to look at it from the customer's point of view, which is what we see on our statements. A positive balance, money in the bank, is called a credit balance.
And that's because the bank is crediting its debt to you. The financial institution owes money to the customer. That's your standard healthy checking or savings account balance.
And then, of course, there's the flip side, a debit balance, again, from the customer's perspective.
A debit balance for the customer is a negative balance. It means you're in the red. This happens when the customer owes the financial institution money. A classic example is using an overdraft facility, or structurally, the entire balance on a formal loan account where you are actively indebted to the bank.
So if I have $5,000 in my checking account, that's a credit balance. But if I take out a personal loan for $10,000, that $10,000 is a debit balance.
Exactly. And operationally, we classify accounts based on their primary function and their expected balance state. So deposit accounts are overwhelmingly designed to hold those positive credit balances. And loan accounts, well, they exist to facilitate and track those negative debit balances.
And we noted that the architecture itself allows for a lot of flexibility.
Yes, and this is key for modern banking. Many transactional accounts are designed to switch dynamically between the two states. A checking account with an integrated overdraft limit is the perfect example. You transition from being the bank's creditor to being its debtor simply by spending more than your zero balance limit. And that switch is immediately governed by the initial contractual terms you agreed to when you opened the account.
Okay, so beyond that balance state, how do institutions categorize the huge variety of accounts out there by function?
Our sources break down the deposit side by purpose and liquidity needs. First, you have the highly liquid transactional accounts. These are the ones optimized for velocity, for daily spending. These are known as current accounts globally, checking accounts, or sometimes transaction deposit accounts in the USA. They offer you maximum access and payment integration, but usually with minimal interest.
Then you have the accounts designed to prioritize holding value over constant access.
Right, those are the savings accounts. They routinely hold credit balances and they might impose limits on monthly withdrawals. That's the trade-off for getting a higher interest rate. An even more rigid category is the time deposit or fixed deposit. This is what's known in the USA as a certificate of deposit or a CD.
And what's the defining feature of a time deposit?
Time deposits are fundamentally less liquid. The money is locked away for a fixed period, say 6 months, 1 year, maybe 5 years. In exchange, you get a guaranteed and typically higher interest rate. But breaking that contract early almost always incurs a substantial penalty, which really highlights the strict contractual nature of banking we talked about earlier.
And finally, the sources mention specialized deposit types, often created to interact with specific tax laws or investment products.
Indeed. These include money market accounts, which offer liquidity that's similar to a checking account, but they often invest in short-term government securities, so they can offer higher yields with minimal risk. We also have securities accounts, which track assets like stocks and bonds, but are held via the financial institution. And internationally, you see these highly specific constructs like the tax-free savings account, the TFSA in Canada, or specialized pension accounts all over the globe. It just shows that banks are constantly creating new structures, all built on that same basic debtor-creditor mechanism, but tailored for complex regulatory environments.
Okay, so given that this whole asset liability distinction is the foundation of the bank's ledger, the next big structural challenge is making sure that ledger can speak globally. How do these accounts identify themselves when they're crossing borders? Especially since one customer can have a checking account, a savings account, and a loan account all at the same bank.
It all relies on the identifier system. Every institution, just for its own domestic purposes, has to use an internal account numbering scheme to uniquely pinpoint each specific account. This prevents, basic errors when processing transactions between a customer's different holdings. But for the global economy, you need interoperability.
And that's where all the acronyms start flying around, IBAN and SWIFT.
Let's really unpack them because they are the absolute backbone of global commerce. For domestic purposes, you have your account number and maybe a domestic routing code. But for international connectivity, the world's standardized on the IBAN. That's the International Bank Account Number.
What does the structure of an IBAN look like? And why is it so much better than just using a regular bank account number for an international transfer?
IBANs are critical because they are structured specifically for maximum error reduction. They're up to 34 alphanumeric characters long, but they are highly specific. They start with a 2-letter country code like DE for Germany or GB for Great Britain, and then they're followed by 2 check digits.
Check digits, what are they for?
The check digits are mathematically calculated based on the rest of the number. It's really clever. If a single number is transposed or entered incorrectly, the check digit algorithm will fail instantly. This causes the transfer to be rejected before it even starts. It's an immediate front-end security feature that saves a ton of headaches. Following those check digits is what's called the BBAN, the basic bank account number, which contains the national bank code and the specific account number. This standardization ensures that every bank system in the world knows exactly where the money is supposed to land.
So the IBAN identifies the specific account. But what about the institution itself, the bank?
That's the role of the ISO 9362 standard, which gives us the Bank Identifier Code, or BIC, but it's commonly known as the SWIFT code. And SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication.
Okay, so what's the difference in function then between the IBAN and the SWIFT code?
This is a critical technical distinction. The IBAN identifies the recipient's account. The SWIFT code identifies the financial institution itself. It's like the mailing address for the bank. But more importantly, SWIFT is not actually the movement of money. It is a globally secure messaging network. When you initiate an international transfer, the SWIFT message tells the sending bank, the correspondent banks, and the receiving bank all the details, how much, in what currency, and exactly where it needs to go. This happens before the actual funds are settled via a separate clearing system. They work in tandem. SWIFT sends the instruction, IBAN confirms the destination.
It's the essential, invisible infrastructure that makes global transfers secure and structured.
Okay. We've established the digital legal claim that is the bank account. Now let's talk about the essential physical key that grants us access to that claim in the modern world, the debit card. The debit card, or check card, bank card, whatever you call it, is simply a portable payment card used in place of physical cash. It's the key that allows us to exercise our financial claim against the bank without having to go to a branch. And its function is defined entirely by its funding source. The core mechanism, and this is what sets it apart from a credit card, is that funds for the purchase must be present in the cardholder's bank account. And they are immediately, or near immediately, transferred directly from that account to the merchant. It's pre-funded spending, which is why it so rapidly replaced checks and cash for everyday transactions across the globe.
And modern debit cards are pretty dense pieces of technology.
Let's look at the standard physical and virtual elements we all rely on today.
Right. Every card has to carry specific identifying details: the bank's name, the cardholder's name, and expiration date. And critically, you have the card number, or the PAN, which stands for primary account number. This is usually 16 digits, standardized across most networks, though you do see exceptions like the 15-digit structure historically used by Discover and American Express. The card number is what allows the network to identify the issuing bank.
But the biggest evolution in security has moved away from those visible numbers and, of course, that easily copied magnetic stripe. Absolutely. We now rely heavily on the EMV chip. EMV stands for Europay, MasterCard, and Visa, the companies that champion the standard. This chip allows for two primary modern transaction methods: contactless use, so tap and go, or the highly secure chip and PIN method.
What is it that makes the EMV chip fundamentally safer than the old magnetic stripe?
Well, the magnetic stripe just sends static data, the PAN and expiration date, which can be easily skimmed and duplicated by a fraudster. The EMV chip, however, generates a unique one-time use cryptographic code, or cryptogram, for every single transaction. This process is often referred to as tokenization. So if a fraudster captures that cryptogram, it's completely useless for another transaction because it's inherently linked to that specific authorized moment of purchase. This dynamic data exchange is the single biggest technological leap in payment security in the last 30 years.
And this technical superiority is what led to the global liability shift, right?
It did, particularly in the U.S. starting around 2015. Networks like Visa and MasterCard mandated that if a fraudulent transaction happened at a terminal that wasn't EMV-enabled, the liability for that loss shifted from the card issuer to the merchant. This, as you can imagine, forced merchants to upgrade their equipment very, very quickly, ensuring widespread adoption of the chip.
And what about the cards we don't physically hold? The virtual numbers.
Yes. The virtual cards, or single-use numbers. These are payment numbers assigned specifically for internet use. They're often generated on demand by your banking app and issued without a physical piece of plastic. They provide a really enhanced layer of security, especially when you're wary of an online merchant. It completely isolates your primary card details from that transaction.
Beyond just paying for things, the card also has to grant access to cash.
Yes, it's a multifunctional tool, fundamentally. It acts first as your ATM card for instant cash withdrawal, subject to your bank's daily limits. And we also see the merchant offered cashback facilities globally, where a customer can withdraw cash as part of a debit purchase. This is mutually beneficial. It saves the customer an ATM fee, and it reduces the amount of physical cash the retailer has to hold on site, which lowers their insurance and security costs.
The global rollout of this tool, though, which feels so indispensable now, was historically a big challenge.
Oh, it was a very messy, historically segmented process. Unlike credit cards, which had a few dominant global players very early on, the development of debit cards was highly country-specific. Every major market created its own local proprietary system. You had Switch and Solo in the UK, Interac in Canada, Carte Bleue in France, EFTPOS in New Zealand.
Which resulted in all these localized payment silos that just couldn't talk to each other?
Exactly. If you took your German EC cart to the UK in the early 2000s, it simply wouldn't work. It was useless. This fractured landscape necessitated major international initiatives after 2000 to improve cross-border compatibility, leading to widespread dual branding. We saw national systems like Germany's Girocard and Austria's Bankomatkasse partnering heavily with Maestro, which is a MasterCard subsidiary, just to gain international acceptance. This convergence was really an economic necessity to facilitate modern global tourism and commerce.
And today, we have 5 major global networks that facilitate all that compatibility and acceptance.
Right. UnionPay, American Express, Discover, MasterCard, and Visa. They provide the global processing rails that standardize the transaction process, allowing a debit card issued in South Korea to operate seamlessly at a terminal in Brazil.
So the card is the key, but how that key works really depends on the specific mechanism the merchant is using. We need to shift our focus now to the 3 distinct processing architectures through which a debit transaction can be finalized.
Right, and a single piece of plastic can be engineered to integrate the functionality of all 3 of these distinct processing systems. Sometimes it'll switch between them based on the merchant terminal or even your choice at the point of sale.
Okay, let's start with the standard real-time method that is, well, it's becoming the global gold standard, the online debit system.
This is often referred to as EFTPOS, which is electronic fund transfer at point of sale, or just P on debit. The defining operational requirement here is that electronic authorization is sought and received for every single transaction. The moment you enter your PIN, the network checks your account balance live, and the debit is reflected in your user account immediately.
And the security there relies on the PIN, which is essentially acting as your digital signature, confirming you authorize the transfer of your claim against the bank.
Correct. And this offers a superior level of security because that real-time status guarantees the funds are available, and the PIN protects against fraudulent use of a lost or stolen card. While historically this required dedicated equipment, the efficiency and security of real-time clearance have made it the preferred architecture globally. It alleviates processing lag and it reduces merchant risk.
Now let's look at the system that introduces a delay, which is critical for people to understand, the offline debit system.
The offline debit system is the one that causes the most confusion for consumers. It carries the major card network logos, Visa or MasterCard, and it's often processed by using a signature instead of a PIN. It connects straight to the person's bank account, but here's the problem. The funds are not withdrawn immediately. There is a distinct noticeable delay, sometimes days before the transaction is reconciled and hard posted to the account.
Wait, if the card is branded Visa or MasterCard, why doesn't it clear immediately like an online transaction? What is the technical or historical reason for this delay, and how do the banks manage the float risk?
That delay is really a holdover from the days when network connectivity wasn't guaranteed, or when transaction processing fees were structured differently. When you swipe or tap using the credit option with your debit card, the system places a pre-authorization hold, ensuring the funds are available. But instead of sending the funds electronically via the Pine debit network, the transaction information is batched by the merchant and sent through the slower signature-based network. This was historically cheaper for merchants in some regions. The bank manages the float by recognizing that the money is claimed by that authorization hold, but they can't technically deduct it until the final settlement message arrives, which leads us directly into the issue of deferred posting later on.
That distinction is so crucial. The third system is entirely different because it bypasses the external account ledger altogether, the electronic purse card system.
This system is a really interesting piece of payment history rooted in the smart card technology of the 1990s. The financial value is stored directly on the chip of the card. It's a physical memory of money, not a remotely recorded account balance.
So it basically functions like a digital replacement for coins in your pocket.
Exactly. The major advantage, which was revolutionary at the time, was that machines or terminals accepting the card required absolutely no network connectivity to verify the transaction. This made it perfect for low-value payments in things like vending machines, public transit gates, or parking meters, where network access was impractical or expensive.
What were some of the key historical systems that really defined this technology?
It was dominant in continental Europe. We had the Geldkart in Germany, the Quickvertkart in Austria, Proton in Belgium, and Monio in France. The German Geldkart, for example, required dedicated loading stations like ATMs, where you physically transferred value onto the chip. Once it was loaded, the transaction was instant, anonymous, and offline. It was true stored value. The reason these systems have largely been phased out or integrated is just the pervasive spread of cheap, reliable, real-time network connectivity, which makes the centralized online debit system more practical and secure for almost all uses.
Okay, let's transition to a system that uses the debit infrastructure, but serves a very specific and growing market: prepaid debit cards.
Prepaid debit cards are also known as reloadable or rechargeable debit cards. Functionally, they behave a bit like an electronic purse system, but the value is often recorded on a remote, centralized server that's linked to the card number. This makes them network reliant, unlike those historical on-chip systems.
The sources highlight two distinct, very different user groups for these cards. The first is the one we typically associate with them, the unbanked.
Yes, historically, the primary market was indeed the unbanked individuals who lack access to or choose not to use traditional bank accounts or credit unions. For them, these cards offer a vital access point to the digital economy, allowing them to shop online, pay bills, and even receive funds via direct deposit.
But in recent years, a second, very different group has emerged, one driven not by financial exclusion, but by a hyper-awareness of digital risk.
That is the privacy and security-focused consumer. They are responding directly to the massive surge in online payment fraud, phishing scams, and data breaches. They use prepaid or disposable debit cards explicitly to safeguard their primary bank details. If a card number is compromised in a breach, the potential damage is limited only to the small amount loaded onto that disposable card. It acts as a crucial firewall.
That's a really practical security measure. If I want to sign up for a service trial or buy something from a website I don't entirely trust, I can just load $25 onto a temporary card and limit my exposure completely.
Exactly, and the sources list several undeniable advantages of these cards. They are inherently safer than carrying physical cash. They enjoy worldwide acceptance if they're backed by a major network. They prevent the user from accumulating debt, and they require no credit check for users over 18. And increasingly, they feature modern security like EMV chips.
But the risks are still significant, especially the unregistered cards, right?
The risks are high, yes. If the card isn't linked to a registered account, losing it or having it stolen means the loss of all the money loaded on it. There's no central record or claim to fall back on. Furthermore, because many of these providers aren't regulated like major banks, technical issues with their network can block your access to funds. And, ironically, if the card provider offers an insecure website for balance checking, it just creates a new exposure risk for the card information.
And we also see governments utilizing and sometimes inadvertently harming this prepaid market through regulation.
Oh, absolutely. The U.S. federal government is a huge user. It utilizes prepaid cards to distribute Social Security and other benefit payments to the unbanked population who lack traditional accounts. However, at the municipal level, we saw some real issues. There were city programs in Oakland and Chicago offering prepaid cards, often tied to municipal IDs. These programs faced severe criticism because of excessive or hidden fees like activation fees, inactivity fees, or high flat fees added onto every single purchase. They were effectively skimming value from the very people they were intended to help.
And some UK regulatory action significantly changed the landscape of the prepaid industry over there.
It did, dramatically. In January 2016, the UK government mandated that banks must offer fee-free basic bank accounts to all citizens. This intervention provided the unbanked population with a viable, official, and guaranteed zero-fee banking alternative. This immediately undercut the fee-based model of many prepaid card firms, forcing several major companies to just exit the UK market because their original necessity had been legislated away.
This complexity just underscores the massive amount of global regulatory and technical maneuvering required here. Let's dedicate our final section to the critical issues of risk management, consumer liability, and the fantastic variety of international solutions that have been devised to solve these problems. We really need to return to that technical issue we flagged earlier, because it is the source of so much customer complaint and genuine financial stress. The conflict of deferred posting, particularly with that offline debit system.
This is a deep technical conflict, where consumer expectation that a debit transaction is instant clashes with the reality of batch processing. When a customer uses the signature debit option, the credit button, the transaction merely places an authorization hold on the account.
So the bank reserves the money, and it might look gone on my app, but it hasn't actually left the bank yet.
That's right. The bank has temporarily reduced your available balance, but the funds are not hard posted. They are not actually withdrawn and transferred until the merchant sends their batch file for final reconciliation, which could be 24 to 72 hours later. This delay, this float, it creates profound risk.
What happens if I make a second purchase, thinking the money from the first transaction is already gone, but that second one posts faster?
That's the classic danger. Since the final posting order can be unpredictable and may not align with the order the transactions were actually made, the delayed posting can result in severe financial issues. It can trigger unexpected overdrafts, cause bounce checks, or make funds suddenly inaccessible. And as we noted, the consequences are often much higher for a debit account.
Right, because in the U.S., for instance, check fraud is a crime, whereas just exceeding a credit card limit is only a contractual breach.
Exactly. The stakes of hitting negative funds are significantly higher, which makes the transparency of the processing system paramount.
So, given that risk, how does the U.S. system protect the consumer when things go wrong, particularly with unauthorized transactions, loss, or theft?
Consumer liability in the U.S. is very strictly defined by the Electronic Fund Transfer Act, or EFTA, which governs debit and ATM transactions. And the timeliness of reporting the loss is everything. If loss or theft is reported within 2 business days, the maximum liability for the customer is capped at a manageable US $50.
What happens if I miss that 2-day window?
The liability drastically increases to $500 if the loss is reported later than 2 business days, but still within 60 calendar days of the bank statement being sent. And this is the part every listener really needs to remember. If the loss is reported after 60 calendar days from the statement date, the customer may lose all the money in the account. The burden of proof just shifts entirely.
That 60-day window is a huge motivation for checking your statements regularly.
It is the ultimate legal protection mechanism for the bank. However, in practice, it's worth noting that most major financial institutions voluntarily offer a $0 liability policy for unauthorized transactions on their branded debit accounts. They do this specifically to build consumer trust and to compete with credit card networks, which have offered similar zero liability guarantees for years.
Beyond consumer protection, we also see merchants actively trying to influence how we pay based on their own transaction costs.
Oh, that's the merchant incentive, and it's all driven by interchange fees. Merchants are often charged significantly higher transaction fees for credit card processing than for debit transactions, especially those processed through the cheaper PIN-based networks. This leads them to steer customers toward debit transactions through signage or, verbal suggestion. It's a practice that the Durbin Amendment in the U.S. sought to control by capping debit interchange fees for large banks.
And the U.S. government also granted merchants more power over minimum purchase requirements for credit cards after the financial crisis.
Yes. A detail from the Dodd-Frank Act is relevant here. It allowed U.S. merchants to set a minimum purchase amount for credit card transactions, and that's capped at $10. This was designed to help small businesses mitigate the fixed costs associated with processing very, very small credit purchases.
Okay, let's delve into one of the most technically restricted and regulated payment types, those specialized U.S. debit cards, like the FSA and HSA cards.
These are a perfect illustration of how the payment network is adapted to enforce regulatory compliance. The Flexible Spending Account, or FSA, the HRA, and the Health Savings Account, or HSA, debit cards are specifically restricted by the IRS for use only for eligible healthcare expenses.
But they look and feel just like a standard Visa or MasterCard debit card.
Yeah.
How does the system know to reject a purchase of, say, a candy bar?
The mechanism relies heavily on what are called merchant category codes, or MCCs, established by the payment networks. These are 4-digit codes assigned to every single retailer based on the type of goods or services they primarily sell. For instance, a pharmacy, which is MCC 5912, is deemed eligible, while a typical department store, MCC 5310, is not.
So the card itself is coded only to work at specific MCCs.
That's the first layer, yes. The transaction can only be processed if the merchant has an eligible MCC. Furthermore, for highly specialized merchants, the system uses the Inventory Information Approval System, or IIAS. The retailer's register has to communicate with the payment network to verify, line item by line item, that the products being purchased are actually eligible medical items. So if you buy Tylenol and a bottle of soda, the IIAS system must approve the Tylenol and reject the soda for the FSA card, often requiring you to use a separate payment method for the ineligible item.
That sounds like a massive technical burden on the merchant, and it's still not foolproof, is it?
It is not. The ultimate catch is that despite all this technical fencing, the consumer remains legally responsible for compliance. If a non-qualifying item accidentally slips through, or if the merchant system fails, the consumer has to repay the account and risks penalties during a tax audit. The card provides convenience, but it does not remove the consumer's ultimate tax compliance responsibility.
That detail really highlights the intersection of banking infrastructure, technical standards, and tax law. Okay, now let's take a final quick tour of some international systems, looking at how different regions balance risk, cost, and convenience.
Let's start with France, which has a deeply integrated system. Most cards there are co-branded carte bancaire or CB plus Visa or MasterCard. French banks historically faced very high fraud rates, which led them to be highly cautious. They implemented chip and PIN very early on back in the 1990s. And legally, banks were held liable for any transaction made without the physical card present.
And that liability must have spurred some real innovation in fraud prevention.
Precisely. To mitigate that non-present card liability, French banks offer a genius anti-fraud measure called the e-card service. The customer can generate a one-time use virtual card number with a defined maximum transaction amount. If that virtual number is intercepted in a data breach, it is completely useless for any subsequent transaction or for amounts exceeding the limit. That proactive, bank-level fraud countermeasure is a direct result of those strict liability laws.
Moving over to Germany, their system found a way to bypass major network fees entirely, though it shifted the risk profile pretty dramatically.
Germany's core network is Girocard, which is often co-branded with Maestro or VPay. However, many German businesses utilize the elektronisches Lastschriftverfahren, or ELV electronic direct debit. This is where it gets fascinating. The merchant reads the customer's bank details from the card's magnetic stripe and has the customer sign a paper or digital debit note, which creates a direct debit authorization.
So why do they do this instead of just running the normal Girocard network transaction?
Cost. It's all about cost. By using ELV, the business completely bypasses the official Girocard processing network and its associated interchange fees. They are simply making a direct request for a debit from the customer's account.
But the downside is the massive transfer of risk back to the merchant.
Absolutely. Because they bypass the network, they forego any network verification or payment guarantees. The critical vulnerability is that the customer retains the legal right to challenge and return that direct debit, a chargeback, by notifying their bank, typically within 6 weeks, without even needing to state a reason. The risk of the customer having illiquid funds or engaging in fraud is transferred entirely back to the merchant. This is why some businesses use internal blacklists, or they switch back to the official Girocard for high-value purchases.
Then we have New Zealand, which optimized for low cost with its EFT POS system for decades.
New Zealand's system was a pioneer. It was processing nearly 3/4 of all retail transactions by the mid-2000s. The unique cost structure was really key to its success. Merchants bear all the transaction costs. They just pay a flat monthly equipment rental fee. Customers are charged 0 fees for EFT POS use. This created a strong incentive for consumers to use the card over cash. However, that domestic dominance meant the network was incompatible overseas, which forced banks to later introduce dual-branded cards to keep up with international travel.
And finally, let's look at the rapid rise of national schemes and mobile-first payments that are fundamentally beginning to skip the plastic card entirely.
This is the leading edge of payment evolution, and it's being driven heavily by Asia. In India, the homegrown RuPay card system was launched as an alternative to Visa and MasterCard. But the true game changer there is the Unified Payments Interface, or UPI. UPI allows bank accounts to connect directly to mobile payment apps using a unique identifier.
So how does UPI bypass the debit card system?
UPI facilitates an immediate, real-time, peer-to-peer or peer-to-merchant bank transfer. You no longer need the card, the terminal, or the PIN. You just scan a QR code or enter a phone number, and the money moves instantly from your account to the recipients. This has drastically reduced the necessity for the physical debit card itself in daily Indian transactions.
And we're seeing this pattern repeating across the region.
We are. Bangladesh launched TakaPay, its first domestic card scheme, in late 2023, relying on the national payment switch Bangladesh. In Indonesia, while they have the Gerbang Pembayaran National or GPN National Debit Card Scheme, the National QR Code Payment System, QRIS, is now reportedly more popular and it's impacting general debit card growth. These innovations really demonstrate that nations are fiercely battling to manage transaction costs, increase security, and create domestic control over their financial flows in a landscape that's been dominated by global networks for so long.
We started this deep dive with the simple definition of a deposit and discovered that legally, it's not your cash, but a claim against the bank, a crucial distinction secured by contract and deposit insurance. We then tracked how the debit card serves as the secure contractual key to unlock that claim, governed by complex technical systems like online debit, the risky offline debit, and the legacy electronic purse.
It's truly a tapestry woven by convenience, cost, and control. The differences we see globally, from the fee-free models of the UK and New Zealand to the strict authorization of online debit systems or the risk transfer models of Germany, reflect varying cultural and legal approaches to managing risk. The evolution of payment is really a story of national systems trying to integrate globally while battling fraud and the inherent information asymmetry we've been discussing.
And we saw that even the newest technologies, like those FSA cards, come with highly specific, technically enforced regulatory burdens for the user. While solutions like the prepaid card market serve not just the traditionally underserved, but also privacy-conscious consumers trying to shield their primary bank data from the relentless threat of digital fraud.
So after dissecting this whole invisible architecture of banking and payments, what does it all mean for the trajectory of our financial lives?
Considering the rising popularity of stored value digital wallets and newer QR payment platforms like India's UPI or Indonesia's QRIS, which allow immediate account-to-account transfers outside the traditional card network, we have to ask a question. Will future generations continue to rely on centralized bank accounts and plastic cards as the primary transaction method, or will the trend continue toward direct, stored value, real-time digital systems? The shift bypasses the plastic card and the complex intermediary steps entirely, making the bank account structure, that debtor-creditor relationship, still essential, but perhaps making the physical debit card a relic of the early digital age.